In today's episode, we are going to talk about how to start a private lending business or a hard money business. We're going to give you a step-by-step guide to start a business. We're going to tell you what entities you need to open up. We're going to tell you who are the different parties involved, investors, lenders, processors. We're going to talk about different lending requirement. We're going to talk about different models, meaning like being a nationwide lender, being more of a local lender. And then we're also going to talk about like how to make money. How do lenders, private money lenders, hard money lenders, how do they make more money? And then how do you scale it? To help us with that, we have Steve Ofer. He is a nationwide private money lender with investor funding. Welcome to the podcast. How are you, Steve?
How are you? Thank you for having me on.
I am so excited about this topic. I was telling you off camera that I have a self-directed 401k, and recently I did a private loan for somebody. And I was telling you how I really enjoyed that process a lot more than having my money in stocks and bonds. And I feel like it's a very consistent return. But most importantly, I have collateral, meaning my
Correct.
money is backed by something. But that kind of took me down this rabbit hole. I read this book called The Banker's Code, and it kind of gives like a little bit of a blueprint for private money. So I wanted to talk about like if somebody wanted to set up a private money business, what would be the first step in your opinion? And then how would they go about setting that up?
So if they're going to make a business out of it, I think the first step in anything that you want to do is to get educated on whatever you're trying to do, right? So the best way to kind of lose all your money, if you're going to be using your money, is to not know what you're doing. And private money is pretty intricate, right? You've got to know the different markets, and you have to be able to know how to secure the money that you're putting out. That's very important. And how do we do that? We're looking at title, right? Title insurance. We're looking at the appraisals, if there's an appraisal in the project. So you've got to be able to analyze all that stuff. It's not about, unless you want to do that at a very small micro scale, right? So the first thing I would say is educating yourself. It could be, reading or doing things like that, like you did a little bit. But in my opinion, the best way to do it would be to actually, if you really want to do it, is find employment with a private lender. To just kind of pick their brain to see what is it that they're doing, how are they protecting themselves, how are they underwriting these loans. That's the most important thing, right? Is being able to underwrite these loans to mitigate your potential losses. That's just the beginning. But once you've done that, to set up a private money business, depending on the state, like you're in California, right? So states like California, Utah, Nevada, Arizona, and I think North and South Dakota, they require you to be licensed, right? But every other state, 44 other states or 42 other states don't. They don't require licensing. So you could basically set up shop to be a private lender without having the licensing. It's not like regular mortgages where it falls under the NMLS, right? So these, you don't need mortgage licensing. So you would have to set up either a corporation or an LLC, whatever your liking is, and then you could basically start. But again, I mean, to start is one thing, but to be able to raise the money, to be able to do what you have to do, underwrite the deals, it's a whole different story.
So let's talk about the different structures associated with a private money business or even a hard money business. I'm imagining that there's one structure where you go out and you go raise the money individually from individual investors or individual parties. And then there's the secondary model where you're basically funding them and then selling them off to a secondary market. Are those the only two structures that are available, or is that kind of like the two umbrellas? And if so, let's talk about business where you're raising the money from private individual investors. How do you structure that, and how do you make money with that?
So there's actually three types of structures. It could be, like you said, you could raise the money yourself.
Okay.
Right? You can sell the loans onto the secondary market. That's structure number two. Or you can broker the loans as well and make money, right? And you could use what's called table funding, where you're basically closing the deal under your name, but you're using somebody else's money to do it that is probably getting institutional money, right? So
Got
someone
it.
like me, where you could originate the deal, process the deal, and then at the closing table, the deal would close under XYZ corporation that you own, but it's my money that goes, and I'm the one that does everything else to help, service the loan and everything like that, so that you don't have the necessary human resources involved in originating and servicing and maintaining the loan, right? Because there's a lot of work that has to go into that asset management part of it. Foreclosing, God forbid, draw management. Like there's just so much that goes into a deal. But let's say you don't want to do that. You want to open up your own company and you want to go out there and raise. Challenges with raising money is a lot of people that you want to raise money from are going to want to make sure that you have the requisite experience to do it, right? So if you're just getting into it and you don't know anything, then a lot of people are going to say, well, you don't have the experience, I'm not going to invest with you, right? But now let's say you do have the experience. You say, hey, I've been doing this, or I've been in this space for a certain amount of time, and this is my experience, right? The challenge there comes is usually the people that you're going to raise money from, it's going to be the dentist, the doctor, or whoever it is that's sitting on some cash. And they're going to be very local, right? So you're going to be a very localized lender, because a lot of people that are going to want to give you money, they're going to want to, for you to lend it in that specific area, right? I would even venture to say, even if it's in San Diego or if it's in Los Angeles, and the guy's living in Beverly Hills, he's going to, not want you to go all the way down to, Long Beach to do it. You know what I'm saying?
Yeah.
Like they're going to get hyper focused on where their money is being lent. Now, talking them into going even out of state to do it, it becomes a lot more challenging, right? But I've seen it, I would say Texas is one of these states where there's a lot of money that's floating around. And there's a lot of private monies that are hyper-focused within a certain market, whether it's Houston, whether it's Dallas, Austin, anywhere. It could be Lubbock. They have very super hyper-focused like private lenders that are there.
How does a business like that actually make money? Meaning, like, is it set up in a way where I'm paying I raise all the money. Let's say I raise $5 million. And then if I'm not using the money, I'm paying interest on that money all the time. Or is it more like on a per deal type of basis where I have a loan to make for 500,000. This investor has 500,000.
It's usually it's something like that, where I don't know too many people that are lending like that, where they actually take the money and they sit on it. Why? Because a lot of people that they're going to are going to want to okay the deal that they're going to lend on, right? So, let's say you said you're where? You're in Los Angeles?
California, Ventura, north of Los Angeles, about 45
you're in
minutes
Ventura
north.
County. Okay,
Yeah.
I know where you are. Okay, so now let's say you're in Ventura. You have a dentist that gave that pledged $2 million. Now you have a deal for 500,000. You call him up. You say, hey, I have a deal down in Sherman Oaks. He's going to say, well, that's Sherman Oaks. It's a little bit far. I'm in Ventura, right? But he says yes. Then you're going to present the deal to him. You're going to have it already underwritten. You're going to say, okay, this guy's looking for $400,000. And then you negotiate. You go, well, he's willing to take it at 10%. Would you be okay with 8%? This way, you're going to make a 2%
spread, basically
money,
arbitrage.
right?
Yeah.
And then you're going to charge points up front and processing fees and different things like that. So now that's how you're going to make your money. Dealing with institutions, right? Like that I do, right? So I have insurance companies, I have big national money managers and things like that. It's very similar, right? Except these guys have an appetite because large institutions,
they want to return, basically.
Well,
yeah,
they want to return, and they can't be hyper focused, right? Because their whole business is not. These are global, right? I mean, these are global. They're global minded to begin with, right? So, and losing $300,000, $400,000 on a deal is not, it's nothing to them. Where
unlike an
a
individual.
dentist or somebody else that has some money, that's going to hurt them. If the guy's sitting on $2 million, you lose $500,000 for him. That's 25% of his net worth is went up in smoke, right? So, but it's very similar. We agree on a certain underwriting box, let's say, with the institution, and we underwrite the deals within that box that we've already agreed on, and we'll do the same thing. We'll say, here we have a deal. We have a package of, let's say, $25 million worth of loans. The WAC, the average weighted coupon of the rate is, let's say, 11%. Are you willing to, and then we'll put it up for bid, right? And then they'll say, we'll give it to the best bidder. Whoever gives us the cheapest money is going to take that, so that we can make some sort of spread, on the money.
Let me ask you this, like, why would somebody go the individual raising money route versus the route that you're going off, where you have multiple people bidding for the project? What are the pros of that route?
Well, but to get to the place I'm at, I've been doing this for over 30 years. So no one's going to get into the business right away and be able to do what I'm doing. It's just impossible. That's not a legitimate option for them to do. It's just very difficult. They can't scale to that point right away. It's going to take them years. And B, it's a reputation thing. They're going to want to see that you've been doing the business for a substantial amount of time. They're going to want to see, what are your default ratios and so on and so forth, before they're willing to, put their money behind you. The route that I usually recommend for people, and the type of course that we're putting together, is to give them two options in the beginning. Either the option of going out and raising some private money around where they're living, or B, taking the broker table funding option, where they get to originate the deal, they get to process the deal, and then they could bring it to somebody like us, where we'll fund the deal. It looks and feels like it's them, right? Because the deal closes under their name, but they don't have to deal with the human resource, right? They don't have to hire. I have a full staff of 50 people, right? To be able to do something like this. There's a lot that goes behind it. There's asset management, so when I'm doing a fix and flip, or if I'm giving money to someone that is putting up a brand new construction, there's fund control, right? There's draw control. I have to make sure that the work is getting done. And again, I live in Nashville. When I'm lending in Albuquerque, New Mexico, right? I don't live there. So I have to have systems in place to be able to control those assets, to make sure that they're getting finished. The projects are going to the finish line in a timely manner, within the time slot that we gave them. If it's a 12-month loan, 18-month loan, that this is going to come to fruition and they're going to have a finished product at the end of the day. So my recommendation is you go two ways in the beginning. You could raise the money, but then you're still going to have to educate yourself, because you don't want to lose money for individuals. You just don't want to do that. You don't want to be that person, right? So you can take courses like the course that we're going to put out, or you work for someone, or you take the route of table funding in the beginning, where you get to learn off of someone like me, right? Where you get the experience, you see how we underwrite the deals, and you still earn a ton of money doing so.
Now, let me ask you this. With the option that you're doing right now, you mentioned that it would take some time to get to that level. Does that mean that you've established certain relationships with certain people that somebody like myself wouldn't be able to establish, or wouldn't know how to establish at the beginning? Or what does that mean?
These are relationships that we've had in place, or just on the secondary market, mortgage markets. It's a small community, right? There's everybody, for the most part. Most of the people know each other for years, and they've been trading loans. I've traded probably over $10 billion worth of loans onto the secondary market. So you kind of build some sort of reputation where people are going to trust you. Because remember, when you're selling, like, I'll give you an example. Last month, we sold over $50 million worth of loans, right? That's pretty significant. So when you have an insurance company that's willing to buy $50 million worth of loans, there has to be some sort of trust there that they know that I underwrote the deals correctly, that my asset management more than anything is strong, right? If anything goes south with the deal, I know how to go in there and fix the problem, right? If a deal goes south and there's a foreclosure, we know how to mitigate the foreclosures properly. There's a servicing component to that. So when you're dealing with larger institutions, believe it or not, the scrutiny and everything else is even more, because these guys, the due diligence that goes, that we go through to get on board with being able to sell these loans to different people, different institutions is tremendous. Sometimes it takes 6 months of due diligence. And this is somebody like me who's been in the business for over 30 years.
Now, in a situation where you're selling a loan like that, like after you sold it, what does that even mean? Does that mean that you got like the money back? And then who still collects the payments and who manages the asset after you've sold it?
We do.
Okay.
So there's different scenarios. There's different things that you could do, right? You could get into a situation where you have a loan, you sell a loan. We never sell individual loans. Like, that doesn't happen.
It's like a pool, basically.
It's a pool, right? But let's say there are some institutions out there who want you to sell the loan, right, and not partake in the asset management portion of it, right? Meaning the draw control or servicing or anything like that. And they want to do all of that stuff, but that's not something we do because we're so hands-on with our clientele, right? For us, it's so important to be able to give the same service, the same exact service to everybody, right? When they come in and they get a loan from us. Because if we sell or if we allow different companies to do the asset management, everybody does it differently, right? They have to make payments to a different servicer. Their fund control is different, and we would never do that because we want everyone.
It would ruin your reputation, basically, if you did it that way.
Like it's almost like any business, right? Let's say it's McDonald's. Every time you go into McDonald's, you're going to get the same menu, the same stuff as always, right? And usually the same sort of service. You don't want that
to disappear.
Yeah, you want to be consistent. You don't want the consistency or whatever you're delivering to change based on who you sell the loan to.
Whenever you're selling in a pool, and this is like so interesting to me because like I've sold almost like 1,000 properties in my career as a real estate agent, and then I owned 57 units in California, in Ventura, California, basically.
Congratulations.
Everything consisting from an apartment complex. But the loan side is something that like I understand it from like a client getting a loan and me getting hard money loans, but this is like a different level of understanding. So when you say that you guys are pooling a bunch of loans together, what does that process look like? And what's like the minimum like pool amount that is typically being bought, like 20 million, 50 million, 100 million, 10 million, 5 million?
So obviously the smaller the pool, the worse the
terms. The
terms are going to be for you, right? Because it's just too small. So you could do mini pools. Mini pools would be considered, let's say, $5 million. Then, medium-sized pools would be around 10 million. And then, more significant pools would be somewhere in the 20 million, 25 million mark.
From the time you fund, how long does it take to sell them? And then what type of money do you use in the meantime, basically, if you're going in that direction?
You have to have warehouse facilities. So you have to be able to have enough credit lines to book those loans on to a credit facility, have the wherewithal to hold it on there, because obviously the private money business is so glorified, right? Everyone thinks that we're always swimming in money, right? But it's the opposite. Because think about it. What is my product? It's money. So if I'm sitting on money, I'm doing something wrong. So I always don't have money. It drives my own wife crazy. She's like, because the more business I do, the less money I have, right? Because even if I have a credit line, think about it, 20% of my credit line has to be in cash, my cash, right? So the more business I do, the more money I have to put up to be able to have the lines to sell. So it's, it sounds like an amazing business, and I'm not complaining. Do we make money? We make, obviously we do well.
Look at this. Look at the
But
smile on the face
no, no,
right now. I'm
no,
just
no,
kidding.
honestly, but what people don't understand is it's almost like you've been in the real estate business,
Oh
right?
yeah,
You deal with
stuff
builders,
that comes up. Yeah,
right?
yeah.
Builders never have money, right? Successful builders, do you know when they have money? When they sell out of everything and they retire, right? Because that's the only time, because builders are
They're
always,
reinvesting. Yeah,
they're
they're
always
reinvesting
reinvesting.
and growing.
They're either growing, reinvesting, or every project that they get in is so cash intensive on them, right? Because even though I'm going to reimburse them, they have to come. You know how it works, private money.
Yeah,
You come out with the money, you come to me, and I reimburse you, right? So the more projects someone has, the worse off it is. All their money is buried into a project. So even on the private money side, it's the same thing. The more money we lend, the less money we have for personal use, and that's what ends up happening. Again, I'm not complaining. I'm blessed to be living the life that I live. I'm very thankful, but it's a cash intensive business. I'll give you a perfect example. On my own personal property, when the rates were going sideways and I didn't know what was going to happen, the same advice I give people, I said, always go out there and make sure you get a HELOC, line of credit, right? A home equity line of credit. Whether you use it or you don't use it, right? If you use it, you're going to pay on it. But if you don't use it, you don't use
you
it, but
have
at
it.
least you have it, God forbid, for emergency purposes, right? So we got a HELOC on the property, right? And my wife wanted to put a new kitchen in, and she goes, like 4 weeks later or 3 weeks later, she goes to see how much money is available, and guess what? There
It's
wasn't a
being
dollar
used.
available. Why? Because I had drawn $250,000, and I had done second position loans on 4 different properties, at 18 to 20%. So she's like, I can't believe you drew out the money. And I tell her, my product is money.
Money.
So
Yeah,
if I have access to money and I see deals, guess what's going to happen? I'm gonna make the deals.
it's gonna
So
get
that's
used.
that's just how it is.
Yep. What's the process? Can anybody get a warehouse line, and what do they look for to establish a warehouse line?
You have to have at least 25%
Hmm.
what's called haircut. So if it's $1 million on the warehouse line, you have to have at least $250,000 in liquid cash.
Okay.
So if you have do the numbers. If you have a $10 million line, that's 2.5 million. If you have a $20 million line, it's
Where do you have to have it with them,
yes.
or yeah, in their bank basically?
Because 25. Now, if you get better, it'll go down to, let's say, 20%, right?
Got it.
On the type of business that I do, right? It's not regular mortgage bank. Like people, like mortgage bankers that are doing FHA loans, or if they're doing, I don't know, conventional loans, their haircut is very minimal, just because that particular product is like a commodity these days.
Yeah.
It gets traded all over the place. I think they have to put. I haven't done regular mortgage banking in like a million years, but I think their haircut is probably 1 or 2%. So
Which
that
is
means
nothing. That
it's
means you
like
have to have 1 or 2%. So if you have $1 million, you got to have like $12,000, $10 to $12,000 basically, or whatever it comes out to be,
it's just so minimal, right?
which is nothing basically.
It's just nothing. That's why everybody and their mothers could get into the regular
Can get
mortgage
a
business, right? But for us, if you get really good terms, you're probably sitting at 20 cents on the dollar. So if I lend out, $20 million, 4 million is my own money.
So we talked about how the warehouse loans, the rates are a little bit above maybe market value. What does that mean? Like, what do we talk about? Like, are they like 10%? Like, if regular mortgages are set
Fluctuates. It's a certain amount over prime. That's how usually it works.
like 1.5%, 2% over prime,
No,
base,
no,
whatever.
it's probably like 3.5% over prime.
Over prime, basically. And then whenever you sell to the pools of money, how do you make money on that? Like whenever you sell it, like do they pay a discount, or are they just like reimbursing you, recapitalizing you, or is there a way to make money on that?
But it's almost the same way that you're going to the dentist on the block, right?
Uh-huh.
You're negotiating. You're saying, the whack on the pool is 11. You guys buy it at 10 or 9. So you get a bid, and whoever gives you the best deal where you can make more of a spread, then
Arbitrage.
you arbitrage
So
it.
you're basically making money on the funding of the loan because you're probably charging like a point or two, and then you're also making money on the resale of the loan whenever you're selling it to resale. Where do lenders make the most money? Do they make it on the front end or the back end, or how does that work?
It just really, I would say, it's probably 50-50.
Fifty
It
fifty.
depends.
So
It,
both.
it depends on your model, right? There's a lot of lenders out there today. Let's say, I know you've heard of Kiabi,
Yeah, I have. Uh-huh.
Kiabi, for instance. So Kiabi's margins are just so small, right? I mean, they're just very tiny on both ends, right? But then, you have other ones like, let's say, RCN or Temple View. Their margins are higher, but what they'll do is they'll work with mortgage brokers. They'll take less on the front end, but they'll try to make as much money as they can on the back end.
Yeah. Can somebody in the first scenario where they're raising the money from private mom and pop shop investors, can they still sell to a pool of sell in a pool and recapitalize their investors as well too?
I don't think it would be significant enough.
To be able to do it, you'd have to do a lot. You'd have to do like a 50. You'd have to have a lot of relationships with a lot of different
Yeah, I
investors,
mean,
basically.
unless you got like a sovereign wealth fund or something like that to give you 10, 20, $30 million, it becomes more cumbersome.
From the time you fund to the time you sell in the secondary market, how long is that process? Like under 30 days,
It could be anywhere from 30 to 60 days.
30 to 60 days. And then these loans that are being sold to these investors, like, are or to these funds, are they like shorter term loans, like like less than a year, less than 2 years, or less
It's
than
anywhere
3,
from 12 to 24 months.
12 to 24 months? And then what's in it for them to actually do this? They just have unlimited money and they need to get a 10% return for the next 12 to
Who's
24 months
who's getting 9%
on
on
their
their money?
money.
Look, these guys are $1 trillion. They're sitting on $1 trillion. I mean, how
And they
much?
need to earn a return, basically.
I mean, how much money is an insurance company like Apollo or Athene sitting on? Trillions, right? And what's their cost of capital? Nothing. I mean, if
So
your cost
this is a way for them to earn a good return on a great return on their money instead of
back by real
basically
estate,
backed by real estate.
yeah,
Fantastic. Now the last one is, it seems like the most simple one. The last one is just the brokering loans. Like what does that model look like?
it's basically you're going to have to learn how to originate a deal, go after the deal. Like, that model is based on, let's say, someone like you, right?
Okay.
Where you have a basic understanding of real estate. You have not basic, but a good understanding, a great understanding of real estate, but you have a basic understanding of, let's say, private lending because you've borrowed money before. So you know how it works, right? You're not a novice. You didn't get into the business yesterday. So you would take our course just to get a firmer understanding of the logistics of how the business works, the verbiage and everything like that, right? Then you would create an entity for yourself, and when you have clients, and remember, this is it's not like a regular mortgage where someone like you, if you were to, it would be a RESPA violation, and if you weren't licensed, you would
Yeah.
get fined, and worse, you could potentially, lose your license or get into, criminal problems, right? Um, these loans are commercial, so somebody that's a real estate broker or real estate investor, such as yourself, you could basically make the deal, right? Close the deal because let's say you're selling a swat of land to a developer, or you're selling a spec home or fix and flip to a fix and flipper. Now you make your commission, and then let's say you add on another 2 points that you want to make on a loan, right? You put it through your company, you send it to me. I do all the processing. I do everything on the back end for you, right? I give you all the human resources you possibly need, right? I do all that stuff. I even fund the loan. I service the loan. Everything is on your name. Your borrower has no idea that it's not your money, right? I've done everything for you. You've closed it. We've even had an agreement with each other where I'm not going to go after that client, right? It's your client for life. And that's basically it. And you just earned, 2 points with no headaches, no, and you just increased, your profit margin. Let's say if you were to make, 6%, or I don't know what's going on in California, let's say 5%, you just made 7%. So
Yeah.
you added a good 20%, 25% on your margin.
Margin.
Yeah, that's amazing. I mean, think about that. If I were to come and tell you, hey, I have a way for you to earn another 25%, that's pretty
Yeah.
significant.
Now, let me ask you this, like, how would I know what your guidelines are for underwriting, or like if a client qualifies in that situation for the
I
type
would,
of
I would,
loans?
I would, I would educate you on it. And just remember, I'm not, right now, the business, even whether you're going to Kiavi, well, Kiavi doesn't do certain things. Let's say like ground up construction, they'll never do like we do. But other companies like me, we're all basically doing the same thing. We're packaging the deals up. The underwriting guidelines are very similar. Why? Because all of this is now getting securitized, believe it or not, right? This stuff is going into security. So they're all getting securitized. And so we would teach you the guidelines. They're going to be pretty mainstream guidelines, right?
Example, can you give us some example of some guidelines?
Uh,
Like
let's say,
65% loan to
okay,
value
no,
ratio,
let's follow
70.
now. Let's do this right now. Let's say somebody comes for a fix and flip. They've done 5 fix and flips, right? We will give them 90% to acquire the property, right, and 100% of the rehab funds.
Amazing.
That's
Yeah.
amazing, right? Let's say somebody has built 5 properties in the past 2 years. We would do 90 loan to cost, meaning if the property to acquire the land is 100,000 and it's going to take 100,000, I'm just throwing out easy numbers, right? If it's 100,000 to acquire the land, 100,000 to build the property, then we would lend 90% of 200,000. I mean, that's pretty good. That's $180,000 that we would do. So we're very aggressive, very, very
Oh,
aggressive.
100%. Yeah, 90% is phenomenal.
Yeah,
Um,
it's phenomenal.
yeah. What about do you guys do DSCRs as well too?
Yeah.
What does that look like for you
I'm
guys?
actually one of the first people. So I owned a mortgage company called M Bank in California a while back.
Okay.
I left that. I was instrumental on creating the DSCR product in
Well,
2014.
I heard you've got a nickname like the Godfather or something like that, right? I just
but that whole DSCR loan, I swear to you, in 2018, we were probably the only company that was doing
which
DSCR
is an
loans.
amazing
It
product.
was. No one knew what it was. I mean, those were the good old days. But now everybody knows. But yeah, so how about this? You can even close a DSCR loan if you're part of my program and under my umbrella. So let's say pick a name. I don't know, XYZ Mortgage. I would even close the DSCR loan under your entity, and people wouldn't even know.
And you'll service it and everything like that.
I'll
What
do everything.
what type of debt coverage ratio do you guys look at in those scenarios? And then how many units is the max amount of units that you guys would do?
So I could do up to 10 units.
Okay, yeah,
I could 1 to 4 units. My debt service, I could even go negative debt service. So I could
yeah,
go down to
80,
0.5 if I
0.5.
want
Wow,
to.
yeah.
Yeah. I don't recommend it, but I can.
So this is what I wanted to ask you. Like you mentioned that a lot of the relationships are based on like your reputation, and you mentioned something called the default ratio. What's normal on a default ratio? What's good? What's bad?
So anything less than 5% is good.
Okay,
Anything more than 5% is bad.
is bad basically. Got it. Okay, so we've talked
That's
about
on my side of the business. On, let's say, regular mortgage bankers, anything less than 2% is good. Anything
is
over 2%
ideal.
is bad.
Yeah, meaning like people are gonna default in your space a little bit more than traditional mortgages, just because of the type of
Mm, yeah,
yeah.
kind of. I mean, our ratio is probably sub 2%, believe it or not.
I love it, which
Yeah.
means you're doing a good job. Okay, so let's talk about like, and this is what I like about the business model that you have versus like a traditional mortgage lender, um, is that a lot of your clients, I imagine, are repeat clients,
Yes.
meaning that like you have one investor and that one investor can do 10 deals with you in a year.
Correct.
And over here, yeah, you have one client, but they're buying a home
Yep.
and then maybe they'll buy a second home in 3 years. So like,
If you're lucky, you'll get that though.
yeah,
You know, probably
if you're
not.
lucky,
And you'll never get the refinance, because whoever is servicing your loan is going to give you the refinance. It's not
they're
like,
going to get it.
back in the day where the guy's going to call the guy that originated the mortgage, because whoever is servicing the loan, as soon as the rates go down, they're going to be calling the borrower and offering them a refinance that you can't even touch.
So let's talk about this. Let's talk about deal flow. So
Mm-hmm.
how do you acquire customers, and what are the best ways to acquire customers in your space? And then obviously the way to retain them is probably good product, lots of products, good service. But how do you go after establishing relationships with different people?
What we do a lot of boots on the ground, like Um, so we have our loan officers in Arizona, loan officers in California, here in Nashville. We set up meetings with a lot of developers, fix and flippers, and things like that. We get a lot of our business just boots on the ground, creating relationships. That's the most important thing. Either we're creating relationships with the actual builders and developers and fix and flippers, or wholesalers that are going to refer us business, or realtors. I'm going after realtors and saying, "Look, you're in the real estate game. How many successful real estate people do you know that don't invest themselves? All the real estate guys that I know that are top are fixing, flipping,
Yeah.
buying, and they're probably the most successful. What This is what people miss. The most successful real estate guys are cherry picking the best projects for themselves, usually, right? So if a deal is coming,
Okay. So basically targeting like investors, targeting real estate agents. Um,
real estate, more real estate brokers than agents.
yeah. Okay, so targeting the real estate brokers and investors, basically, and just establish. I'm imagining so like when I first did my first flip, I think I
Hmm.
had like 30% down on the flip, and now like I have relationships with people like you that do 90%. And when I look at that, I'm like, man, like that's so much better than having to put like a lot more down. And obviously, you work your way up there, but I think a lot of it had to do with I didn't have the right relationships at the very beginning. I when I learned about flipping, it was just like, okay, like who's willing to actually give me money and who will allow me to work on my first project, basically.
But remember, again, your experience. So we're willing to go.
90% because of that. Yeah.
Right?
Yeah.
In our business, experience is more important than anything else.
Yeah. So let me ask you this. Who are the different players in a setup the way that you have it? Like, meaning, all right, so you have your loan originator, you have a warehouse line, you have the pool investors, you
Mhm.
have who are the people in the background? You have an underwriter. Who else are the different players?
We have processors, junior processors. We have account executives. Um, we have you know people that are in charge of the servicing, asset management people. Then you have underwriters. You have closers, funders.
What do all these people do? Like, so for example, like a processor and a junior processor, what do they do?
So a junior processor would call the clients, so on and so forth, and make sure that they send the paperwork that's required in. The processor will take it and review it before it goes into the underwriter.
Okay.
And then the underwriter will review it, give a final stamp of approval to make sure that it's correct and it's exactly what he or she was asking for.
Got it. What about account executive?
That's a guy that basically has the accounts. It's the sales guy, it's the loan officer.
It's a loan officer, basically. Got it. What about the servicing? How is that structured? Is that
So
uh,
we use a sub servicer. We have multiple sub servicers, but we have in-house people that call and make sure that the payments are made on time.
got it?
Or if someone's not making payments, find out why they're not making payments, and how we can make sure that they make payments.
Yeah. Okay. Like, so it's basically like if I were to go out, like I got a private loan for an apartment complex. We hired a servicing company to service that loan. It's the same thing that you guys are basically doing.
Yeah.
Okay. What does the asset management look like? Obviously, I know what asset management looks
Asset
like.
management, well, it's split up into multiple things, but the most important things that the asset manager does is make sure that the project is on, is going in a timely manner, right? Managing the asset, making sure that draws are going out timely, that people aren't waiting for reimbursements for 2 weeks, right? So if let's say if somebody comes in for a draw, they send out the what do you call it? The appraiser or whoever it is that's going to go out there and assess that the work was done, make sure that's ordered and timely, and then when that report comes back, make sure that we reimbursed whoever it is, our borrower, in time. That's part of the asset management. Then if the deal goes south or if there's a problem, to step in, try and fix the problem, see why they're not making payments, and try and handle it. Then if the deal does go south and you know, there is a potential foreclosure. See how we can mitigate the losses.
Yeah, to make it as simple as possible, basically.
Right.
Got it. Okay. And then funders and closers, basically somebody who's just
The
funding
same,
the
the same
the
thing.
the loan
Yeah.
and closing it out. Fantastic. Good. Anything else that you think we missed? Like if somebody's looking to start a private money business or a hard money business, what else would they need to know?
They're going to get my course. Today, they can find me on Instagram, but soon there's going to be a website that's going to be put up for the course itself. And that's going to be in my link.